Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 176. And today we're going to talk about one of the most important but neglected parts of a strategy, which is the drawdown. I mentioned this on Twitter as well this morning. And I'll show you how different drawdowns can bring about very unexpected results, and why just chasing the returns aspect of a strategy or the beta factor of the strategy is not enough, and the drawdowns itself, to my understanding, is one of the most important, rather the most important part of a strategy. So let's dive into today's market action first. So it seems that the budget rally, the few days before the budget and post that, have totally fizzled out. Nifty has returned to much below the budget lows, budget day low as well, which is never a good sign. And an important day when it breaks out in either direction. Breaking back that day's low or high, whatever may be the situation, is never a good sign. So from that perspective, I think market has broken an important support, and we may see further downside to 16,800, 16,400 if I may guess, but I'm just guessing there. So, and as you very well know, that our systems, our products don't really care about what anybody is guessing about. So, and my guess is also as, unimportant to the system and to the products as anybody else's is. But nevertheless, we all like to forecast, speculate, and have a view. So from that view perspective, I think we are going downstairs. Our trading product has also been short since few days, and it does seem like the trend upward is not strong enough, at least, and the FIIs continue to sort of sell into the market, given the very high valuations on significant number of Nifty stocks, in my personal opinion. The good part about the market is that we are seeing a recovery in the beaten down PSU bank sector. And most of the results of the PSU banks that are coming out, whether it was Canara Bank, Bank of Baroda, and several others, they have been very heartening. And that seems to be holding the Bank Nifty up better than Nifty actually. So private banks, however, are getting smashed down, as you can see in today's sector report. Minus 2.3% were private banks, whereas PSU banks are plus 0.9%. So completely polarized banking sector, with PSU banks going up and private banks going down. So there is a churn that is happening from high growth or very high valuation stocks into maybe more of value, or at least closer to value. So that churn is definitely happening. Other than that, most other sectors that were recently doing all right, metals, real estate, also took a beating. And funnily, FMCG, which was already beaten down, was thrashed at minus 2%. Consumption stocks minus 1.7%. Pharma minus 1.5%. So even defensive sector, IT, minus 1.3% is getting smashed down. So this all is pointing to very, very bearish sort of sentiment, especially in the large cap stocks. The mid cap stocks, as we will see here, and the small cap stocks are still lesser damaged, I think, than the large cap names. And the small cap index and the mid cap index were down by about 1%. The small cases run by Weekend Investing also were down in line from 0 to minus 2% roughly, and nothing much to really talk about on this front today. But as long as things remain in line on the downside, and if you can outperform on the upside, then that is the sort of key magic that you want to create. And we'll talk about this exact thing in today's topic of the day. So single most important aspect of strategy, lower and shorter drawdown is the single most important reason for a strategy to outperform over time. This was the tweet this morning, and I gave some statistics based on NNF10, one of our strategies, and I'll elaborate on this today, why I'm saying that this is a significantly important aspect of a. So I'm taking you to another tweet of the day, again linked to this aspect of lower and shorter drawdown. So I said this, that there are two strategies, for example, where the first 6 months we had a down phase, and the next 6 months we have an upward phase. And let's say the index moves down 25%, and then moves up 50%. So what will happen is that, if the index is at 100, it will move down 25% in a drawdown, go to 75, then move up 50%, go to 112.5. So net returns for the year is 12.5, right? This is very simple. And then we said that let there be two strategies. Strategy A makes 150% in uptrend and loses 50% in downtrend. So you have a very high outperformance on the upside when it happens, but a sharp drawdown when it happens in strategy A. Strategy B says we have 75% in uptrend but 25% in a downtrend. So sort of half of what A does on the upside and half of what A does on the downside also. So you would intuitively think that these two are going to give you a similar impact, similar return. And what usually happens is that, let's say you were in the market for looking for some mutual fund or for some small case, and you're reading a report which were the best mutual funds of the last 1 year, which were the best small cases of the last 1 year, which has the highest return, and you want to invest there, right? But that is not the only aspect of that strategy. So I'll show you how. So strategy A, remember, makes 150% in uptrend, loses 50% in downtrend. The other one makes 75% in uptrend, loses 25% in downtrend. And the intuitive selection here is to go with A, right? What happens? First 6 months, let's say we have a downtrend. You lose 50% here, 100 goes to 50. Then you get 150% up. So 50 will go to 125, right? You get 25% net returns on strategy A. Strategy B, you go 25% in downtrend, you reach 100 goes to 75, and then you get a 75% on that 75 and you go to 131. It will be 31.25 actually. So you get a 31% return here. So intuitively A was more attractive, yet it had more drawdown, possibly even longer drawdown. But at the end of the day, it did not make you more than strategy B. And when compared with the index, both did better than the index, but the pain that you would have felt at a 50% drawdown would have been much more reduced if you chose the strategy with 25% drawdown. So what did strategy B do relative to the index? It was in line with the index when it went down. So market fell 25%, strategy B also fell 25%. But when market rose 50% from there, the strategy B rose 75%. So it made up, rather it outperformed on the upside but stayed in line on the downside and hence overall outperformed. Strategy A, however, underperformed on the downside by a big way, going down 50% versus 25, but then outperformed on the upside on a big way, and still managed to outperform the index. But the kind of heartburn and the pain you would have felt at minus 50%, not knowing whether this will do the 150, is enormous. And that also takes a toll in terms of bad decision making, bad position sizing, or taking out money at the wrong time, not adding at the right time, etc., etc. So while choosing strategies, drawdown is a very, very important aspect of the entire game. Now let's go back to the presentation. So let's now look at what has each of the 3 or 4 suggested products that we are showcasing have done in a downtrend and an uptrend. So NNF10, August 18 to March 20, which was its major drawdown, the benchmark index went down 32.4% and the strategy went down 21.3%. So on the down also, from the maximum down point, the drawdown, on the down also the strategy is outperforming the underlying index. And what happens on the upside? On the upside, the strategy has done pretty much in line with the underlying index. So outperformance while going down, but in line while going up, overall outperformance, right? Here you can see the detail. So downtrend, strategy goes down 21% versus 32% of benchmark. On upside, strategy slightly underperforms, but more or less in line at 91 versus 94. And total, it outperformed plus 50% versus 31%. Just see the magic of lower drawdowns, despite not having a outperformance on the upside for this strategy for this period. Another one, Mi EverGreen, 2018 till April 2020, index CNX 200 is the underlying index, drawdown of almost 29%, strategy goes down only 17.2%. So outperformance while going down, and from there index goes up to 107, so 107% up, strategy goes up 124% up, outperformance on the way up. So outperformance going down, outperformance going up. You can see here outperformance 17 versus 28 plus 124 plus versus 107 combined plus 85 versus 47. Dramatic, magical enhancement of performance because outperformance going down, outperformance coming up. Another example, MI20. This is a mid and small cap based strategy. Again, drawdown, instead of 45% on the index, 36% odd on the strategy. So outperformance on the way down, and on the way up, massive outperformance, 361 versus 269. Overall impact, 132% versus 48% on the index. The multiplier impact of outperformance on the going down is enormous. I cannot emphasize more on this. Another example, MI35, again drawdown, 56% drawdown, small caps. Strategy down 30%, same time period. Upside, 355 versus 306, again outperformance. 29.9 versus 55% on the downside, 255 versus 206 on the upside, massive outperformance, plus 149 versus 35% on the index. So you are able to see that while we mostly chase the outperformance, overall returns, but drawdown analysis is very, very important for you to, especially when you're looking for new strategies to deploy your money in over next many years. You must understand what has been the drawdown impact and drawdown analysis of that particular strategy. All these strategies that I have just shown you, I am putting the links in the description in case you wish to go subscribe to them. And this is the end of this very important daily bite. I hope some learning came out of this, and I'll see you in another video. Bye.